Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome to the Greedy Trader channel. Well, I'm not exactly greedy, as most of you old watchers of the channel will testify. I have the most conservative approach to trading. It's just a nice parody idea from the Gordon Gekko mantra. There are only two kinds of traders, the greedy ones and the fearful ones.
Greed, for lack of a better word, is good. Greed is right. Greed works.
Those of you who are new to the channel, this is where you can learn how to really trade like a professional. Every video I make is packed with real examples with before and after scenarios, so you can see that it is simply a question of sticking with the plan, not changing it because you're having an emotional meltdown. Alright, hi guys, welcome back. So most people that I speak to, they're either tired of losing money, tired of not knowing how to build their own trading strategy. So that's what we're going to talk about today. Today I'm going to talk to you about how to build your own trading strategy. I'm going to go step by step. I might have to do this over a couple of series, like just so I can make sure we all understand this. I'm going to give you a ton of value, and I'm going to help you understand how you can build a trading strategy that will make you money over time, and it's going to be based on purely statistics. This is not one of those arbitrary videos where I'm going to sit here, saying draw a trend line there, draw a trend line there. That's not what's going to happen. In this video, I'm going to talk you through step by step the entire thinking process, how you should see it, what you should be considering, everything you need to know to make this work for you. So let's get into the meat of things. So step 1, define whether your strategy is going to be a contrarian or trend-based strategy. In my opinion, this should link to your personality type, or essentially the market you want to trade. Right, so for example, if you're contrarian and you try and trade a trend, you won't be able to hold a trade. So that's a personality thing. If you are into trends, you're not going to build a mindset for you to be a contrarian, right? Again, if you are trying to trade trend-based strategies, then it's very, very important that you find an asset that's kind of an inflation hedge, because we know that inflation is the biggest driver of price in general when it comes to asset classes. So if you found an asset class that was an inflation hedge, hint, a couple examples, gold, the S&P 500, then you're going to get a lot of trendy behavior, and this should be a very attractive asset class for you to trade if you are considering trading trends on an intraday basis. Of course, if you're more contrarian, then obviously FX will be a really good place to start. FX doesn't really trend as much. It is very, in my opinion anyway, it's a little bit sideways in price action and a lot of whipsaws. Most people who trade Forex struggle and often tend to lose a lot of money just because of the way this asset class is designed. And we have to bear in mind that cash is not an inflation hedge, right? So essentially cash is continuously devalued. So naturally there's going to be some challenge if you're trading cash when it comes to trendy behavior. There's some FX pairs, in fact, that are completely sideways, like the Swissy, for example. Dollar Swiss, you might get a lot more sideways price action. And then, of course, you've got these assets that, like the yen, for example, is always devaluing against the dollar. So in many ways, the dollar acts as an inflation hedge against the yen. So you get a bit more trendy behavior on the yen. And that's kind of a very quick masterclass in understanding what asset is going to trend and what is not going to trend. Again, in the short term, if you get into commodities trading, for example, you'd find asset classes like live cattle, feeder cattle, and so on will have really good intraday trends that you can take advantage of. But there's always a limit to these things, so you're going to see a lot of sideways price action over a longer time frame. So they're pretty good to trade intraday. Again, if you are a commodity investor, these asset classes really factor in inflation quite well. So again, if there's like a high interest rate environment, you would tend to see these asset classes rising. And I can show you a couple of examples as well, so you can understand how this actually plays out. Right, so hopefully this makes sense. So the first step is, if you're a contrarian, go after an asset class that is contrarian based. If you are a trend follower, go after an asset class that is trend following based. It's not complicated. If you do anything else, you're going to find yourself in extreme internal conflict, and you end up just paralyzing, basically. Step 2. This is the interesting bit. This is the bit where you come to think about, how can I identify an actual trade execution point, right? So in order to do that, I need to find something that is visually obvious and is repeated consistently in terms of behavior, right? So whatever asset class it is, so let's say I'm attempting to trend follow, right? And I want to trend follow on an intraday basis. Then the first thing I'm going to do is to find something that is visually repeatable. Now, I'm going to say something I've probably never said before on this channel. There is nothing wrong with you trading on a 1 minute, 5 minute, 10, 15, 20 minute, whatever time frame you want. Right? If you can visually identify something that repeats on that time frame, then you can trade that time frame. And there are a couple of things you want to bear in mind when you're thinking about time frame to trade. First and foremost, if you wanted to trade a longer time frame, you're going to have some challenge, especially on the capital and the risk. If you are a new trader with not a lot of capital to bring into the game, then it doesn't make sense trying to trade a daily chart or weekly chart. It just doesn't make sense. This is suited to someone who has a little bit more capital, and this will become evident as soon as you start trading, because it's going to be down to personality. If you put on a trade that was going to take maybe $1,000 worth of risk on, say, a 1 hour time frame, you might feel quite bitten if the trade moves against you and takes you out for $1,000, but your account was only $3,000, for example, right? That's a tough hit to take. Right? So again, but that's what might be necessary in terms of risk to cover your visual pattern on that time frame. There's nothing you can do about it. It's just the reality of what you're facing. The market is fractal. So if I were to take off the price scale on my chart, you won't be able to tell if this is a 1 minute chart. You won't be able to tell what asset class it is if I took away the fact that it's telling you you're looking at a chart of gold, for example. So in my opinion, because the market's a fractal, you can pretty much trade in any time frame. All it comes down to is pretty much having good risk management. Nothing else. What does it matter if you're trading a minute chart or you're trading a 5 minute chart? Right now you're looking at a 1 minute chart of gold. I mean, it might as well be a daily chart. I mean, look how slow the bloody thing's moving. There's nothing going on, right? You're not going to have trouble making decisions. The time frame's fractal. You can pretty much see some really nice little trend behavior on gold. You can see that from the Asia session right down to the early European session. Obviously now we're sort of approaching that mid-European part. It's been pretty trendy, right? For the most part. So once you've identified your behavior pattern, that repeated behavior pattern that you're looking for in your chosen asset class, then you want to move to the next step, which is you want to be able to test that. You can back test it, you can forward test it. The good news is there are a lot of platforms now that offer replay facilities. So you can always take this, replay it, and see what the expectancy was. Now, again, what's the logic behind this, right? Now, as a new trader, it doesn't make sense that you start to pick up very complex tools with a lot of statistical based assumptions baked into them, right? Or pick up a lot of tools that are rather complicated that with quite a lot of visual effort in order for you to identify a position that you want to take. That's what we call friction. There's a lot of friction there. It means that some way down the line, this is going to go wrong. And this is exactly what you are trying to avoid. So humans as a species, right, we are visual creatures. So our brain makes sense of the world visually, right? Some creatures, they don't need vision to get about in the world. They use other senses, but sadly, humans, vision makes up for a lot of how we experience the world. Obviously, people who don't have vision have a completely different experience of the world, but for the vast majority of us, we do have vision, right? And that means that our entire perception of the world is visual. There's a really good movie, if you want to test this theory out, there's a really good movie that Apple TV released, and I can't remember the actual, it's called C, I almost forgot. The series is called C. If you haven't seen it, it's great. It's got Jason Momoa, I believe it is, is one of the characters in the movie. It's a really interesting concept. When I first saw it, I thought, yeah, actually this makes a lot of sense. If people don't have vision, it's going to be, if everyone in the world didn't have vision, it would be a crazy world, right? And then there were a few people who did have vision, and that's when everything went crazy. But anyway, if you haven't seen the series, I won't spoil it for you, but I would certainly think that you should take a look at it, and it will help you understand as humans, we are one of the only species on the planet, right, that have pattern recognition capability on a highly superior level, very extreme level. The way we experience the world visually and what we can do with our vision is one of the reasons why we're a dominant species on the planet. So our pattern recognition ability is second to none. Right? Our ability to see things changing in our environment and adapt to it super fast. I mean, it is what it is. It's what makes us human. Our brain can process this stuff faster than any algorithmic computer, whatever it is you want to think about that is high frequency trading here and there. It doesn't beat a human being. Again, if you don't believe me, just look at what it would take if a computer was to function rather like the human brain. You know, I hear all this stuff about AI and it's pretty exciting, but AI can only be a tool to the human brain. It can't necessarily replace humans, right? It can act intelligent and everything else, but its ability to process information, I mean, humans, we can do better, right? It's my personal belief. So I think in the long term, of course, our world's going to be transformed by AI, but essentially, humans are always going to have the edge, right? That's just what I think. So if that's the case, and you're coming to something like trading, then visually is where you want to go. You want to be able to identify things very quickly visually. So I would always start with picking a visual pattern, right? So it can start with something simple, right? And I'm going to give you an example. So a visual pattern that might be repeatable and obvious is typically what we call failure swings, right? So these are patterns that often look like this, right? Failed to do a new low, and then essentially breaks out on an inflection point and moves higher, right? There's a guy called Scott Carney wrote a book on patterns in general, called them all kinds of crazy names, but essentially all he was trying to describe to most traders is the failure swing, but his trading system was a contrarian one. So his idea was to trade at the termination of the failure swing. Whilst of course someone who's following a trend will see the end of the trend, the swing point, and then they want to trade in the direction of the swing point. This is a repeatable pattern visually, right? You can see that through the price chart. We go up, we terminate, we do a failure swing, we terminate, and you can see clearly here we set up for a clean W structure. So whether you're getting long here with risk at the low, or you're getting long here with risk at the low or the low, it doesn't matter. It's a repeatable pattern. It happens consistently, and it's reliable enough that you're going to get a directional move in it, right? Because it's normally the beginning of a trend. It's not going to be the case all the time, but if it's the case 30% of the time, even 20% of the time, pretty decent risk management could see you a profitable trader. It's really simple, right? And that's of course if you're considering asymmetric risk profiling. I won't get into that right now, right? So that's step 2. Find a visually obvious, repeatable pattern, something that you can always identify, right? Visually, because again, it makes it simple. If I have to look for too many things and I have to look at too many things to make a decision, there's too much friction there. I'm going to have analysis paralysis, and I don't want that, right? I want to be able to execute as much as possible over a longer period of time and let the maths take over. Eventually, probability will gain the edge. If I do something 100 times and 30% of the times I'm right and I have an asymmetric risk reward profiling, I'm going to do well. That was the importance in step 1 of picking an asset that trends. If I'm trying to achieve an asymmetric risk profile on an asset that's contrarian, that goes sideways, then it's not going to work. I'll be wasting my time. I'm going to have more trades that are losers than are winners because my asymmetric risk profiling, and by that I mean my 1:3, my 1:2, my 1:4, my 1:5. Now again, those 1:4, 1:5 is technically not possible because of something called implied volatility. Right? So because generally all asset classes have some degree of IV rank, it's going to be really difficult for you to achieve that on an asset class that has a low IV rank. You'd have to be pretty much a genius to be able to achieve an asymmetric risk reward profile that's going to be beneficial to say a 30% of a trade probability. That is going to be challenging. So this is not something I would advise anybody to do. First and foremost, right, is consider what it is you want to trade. Don't just pick up an asset and then make up a risk reward profiling. This won't work for you. So think about it, and in my experience, the most trendy assets can give you easily a 1:3. Anything else is an outlier, right? So you might get days where it might give you a 1:6, 1:7, but if you aim for 1:3, you're guaranteed to get it most of the time, right? If the asset's trendy, which is one of the reasons I selected gold or the S&P 500 as my examples, because these will definitely get you there. Obviously, if you're a Forex trader, you're going to completely disagree with me because it's incredibly difficult to achieve an asymmetric risk profile on Forex. Most people are going to be shooting for 1-to-1. In some cases less, and looking to expand the probability to something like an 80-20. My 80% of my trades right, 20% wrong, but I'm taking profit 1-to-1 or less. There's no other way to look at this, basically. In a nutshell, or they're going to adopt a contrarian approach, in which case they could probably eke out a 1-to-2, a 1-to-1.5. But again, if you're trending, it's going to be a headache. Alright, so again, going back to the question of risk reward profiling. Now remember I said to you earlier, the market is fractal. So you want to go, in my opinion, if you're going to do intraday trading of any kind, you want to go the smallest time frame possible, right? I don't care what anyone has to say. If you look at some of the big traders in prop firms like the real ones, you know, where a lot of these guys are trading stocks, or they're trading commodities, like stuff that's exchange based, probably not so much CFDs. But if you look at these big firms with lots and lots of capital deployed against intraday trading, they're trading really minuscule time frames. This can be done by trading what's called a depth of market or a dome, order book, as it's sometimes referred to. It could be done by trading some kind of bookmap software. In the world of trading, timing is everything. Gain the edge you need with Bookmap, the ultimate platform for real-time market visualization. Track the very pulse of the market with their liquidity heat map. Visualize historical and real-time order book data to spot opportunities as they emerge. Analyze buying and selling pressure with their customizable volume dots, giving you precise insights into the market behavior at every price level. Stay ahead with their advanced order book visualization. See the full picture, current and historical order flow at your fingertips. Monitor the market movers with their large lot tracker. Identify significant trades and follow the footsteps of major players. Unlock deeper analysis with powerful proprietary indicators like the imbalance indicator and iceberg order detection, designed to give you the ultimate edge. Trade anywhere anywhere, anytime, connects to leading global markets, including futures, stocks, and cryptocurrencies, all in one platform. Take control of your trades with an interface designed for efficiency. One-click trading, drag and drop order adjustments, and real-time updates keep you in command. See the market like never before. Gain clarity, confidence, and control with Bookmap. Start your free trial today and get up to $120 off yearly plans. Help support the channel and Bookmap by using the link in the description. Or it could be done by trading essentially some degree of the order flow, where you can get a minuscule look into what's going on in the market, right? So you're going to find a lot of traders who are trading time frames that are essentially very, very nano, micro, and so on, right? For me, you don't want to maybe jump to the dome yet. That would defy everything I'm trying to tell you. So you probably want to start with a 1 minute time frame, like I've done right here. Really simple. You can get a really big picture of the market by just simply zooming out, and you can get a close-up picture of the market by simply zooming in. Not complicated. Second thing is that once you've identified the smallest time frame, you just want to have some statistical measurement of essentially, is this market going to be able to generate my risk reward profiling? You want something tangible. So the first thing I tend to do is, and again, just make sure that the spread will accommodate this, because some CFD platforms, the spread's so massive that you can't potentially trade a minute time frame. But if the spread will accommodate it, then fantastic. If it won't, then you probably have to change broker or something, I don't know. In any case, you want to make sure that you can prove the volatility, right? Easiest way to do that is to look at what is inflation on a month-to-month basis in the dollar or in the US economy, for example. So let's say inflation is 1% a month. But when I'm talking about inflation, I'm actually talking about the devaluation of the currency, right? What does that look like over an annual basis? Now, typically it's between 10 to 12% a year the dollar devalues annually, right? So it doesn't matter if they're moving interest rates here and there. On a net basis, it devalues 10 to 12% annually. Obviously, we had COVID, so it was a much bigger decline in 2020, and we're making up for that with interest rates. That's all that is. But over a long enough timeline, it's 10 to 12%, so that's approximately 1% a month. So whatever asset we're trading, in my opinion, would have to inflate by 15% to 24% on average on an annual basis, right? And that kind of IV rank will allow you to be able to prove the volatility. So what I'm trying to say is that if you're trading an asset that is inflating at about 6% a year, which is typically what you get with an FX pair, let's take sterling for example, it's roughly about 6 to 7% a year. That's what it's inflating at. And the issue with that is that it's just not going to be suitable to trade any kind of sustainable long-term intraday strategy. It just won't be. Sorry guys, sorry to break it to you, it's just not going to be. What you're going to be able to do is do a lot of contrarian type stuff, a lot of swing trading for example. This is going to be feasible, but you're not going to be able to do this effectively intraday, right? And if you try and do it, you will understand what I'm trying to say when you're completely out of pocket and lost a ton of money. So the goal should be to target asset classes that are doing anywhere from 15% to 24% IV rank. And I said if you use that calculation, right, so it's not really difficult, you just have to look at how much gold appreciated on an annual basis, and that should give you a pretty good picture, of course, of how you essentially what asset class to pick. Alright, so once you've done that, it will now be time for you to come in and say, okay, well, let me put this idea to the test, right? Let me put this theory to the test. I've identified an asset, I've proven its volatility, I've identified whether I'm contrarian or trend based. I know what my personality is, so again, if I'm suited to trend trading, that's what I'm going to go. If I'm not suited to it, I'm not going to go there, right? So I've identified that. And lastly, I'm ready mentally to start putting this to the test and trying to see how this could work, right? So I've done all of those things. I'm check, and I'm ready to go. So the next step would be to start to visually backtest it, which means that I'm going to look at a chart of that asset on that time frame, and I'm going to test whether I can visually identify failure swings that extended to my risk reward profiling. And if I can do that, I've got the beginning of what could be a strategy that I could use that's going to have a probabilistic edge, right? And then I can start to say, well, I'm going to collect enough data, and for me enough data would be go back and look at anywhere from 50 trades to 100 trades where you could see this pattern repeating continuously, right? So that's your proof of concept right there. Once you've got that, it's time to move to the next step, which is we're going to need to forward test some of this stuff. Right, so let me give you an example. Let's say that I visually identified the failure swing as the strategy that I want to utilize. So really simple. We're looking at it in real time right now. We can clearly see as this market extended to the upside, we had a failure swing to the downside. Right, so we pulled up, and we have that M structure, and we broke the low right here, right? Our execution should be coming as soon as we're taking out the low. We want to get short, and then we're looking to see that risk reward profiling. We're not optimizing yet. I'll leave that for another video. This is just a basic idea that we want to experiment with. So in real time, I would be short this market at this level, and then I'll seek to manage the position. Now I haven't optimized anything. I'm just looking at it from a very basic standpoint. I'm not optimizing. If I was optimizing, I might look at things a little bit differently, but I'm not optimizing. I'm just going off that visual pattern recognition that I can see clearly. We've got a cycle, we had a pullback, we moved up, failed to do a new high, we pulled back again, and then we cycled, failed to do a new high, and then we broke lower, and then we start to flush, right? When we're optimizing, we might throw a couple of things in, but I'm going to leave that for another video. The next video is going to be on optimization. I'm going to tell you exactly what you need to look at in order to optimize. There's so many people out there picking various different things to optimize, and it gets crazy after a while. You don't want to do that. You want to pick 1 to 2 things that are going to guarantee optimization. And that's what I'm going to show you. Right, so this is one thing we've identified straight away in real time. So as I'm doing this video, I'm just literally seeing this visually, and that's where this trade developed as we were doing this video. Likewise, if you were trading, say for example from the London Open, you can clearly see that we were traveling lower, we started to consolidate, and then we went up, failed to do a new low, broke, had a failure swing up here, based and broke again, right? So again, this would be typically, so let's draw this out. So we went in, right? Remember, you're the London Open, failed to do a new low, cycle back up, and broke the low here, right? Really simple. That becomes a good entry. We had a second opportunity for entry a little bit higher. So again, if you want to choose this as a window, as your entry point, risk below the low should be roughly about 2 points, and that will come to optimization. I'll tell you exactly what we look at for risk. And if we go to all the way to the high, it's 3.89, but ideally we should be able to get a 3-to-1 on the trade. So this is proven that it's possible to achieve a 3-to-1 on average, with the market doing a little bit more extension over that. So you shouldn't have a problem achieving that with the volatility of gold. In fact, over the past couple of days, the volatility of gold has actually gone down. So it's actually trending less than it has been trending on future days or prior days. Right, so it's very possible to do, and it occurs a lot of the time. Okay, so that's another example. So in the course of just about an hour or two, we've seen 2 opportunities where essentially markets ended up going much lower. Right, just delete all of this stuff out of here. Right, so anyway, that's just basic. It's a no-brainer, right? Everyone should be able to do this. Right? Obviously, in the wee hours, like in Asia, we're not going to trade on those times. Let's be realistic, right? And it's just what it is. So if we're trading a liquid session, that's the London Open or the US Open, we should be able to identify a lot of failure swings that we can take advantage of. There are other things that we're going to talk about very shortly when it comes to building a strategy, but this is just the visual pattern recognition bit, and this is the bit where we go back and test to make sure this stuff is viable over time. So in the next video, I'm going to go back and I'm going to go show you exactly how you optimize. So hopefully you understood what a failure swing was, right? Essentially, we're doing lower lows until we reverse, create an inflection point. An example of an inflection point is we're doing lower lows and then we reverse and we take out this high point here and create an inflection, first and foremost. And then we come and form what we like to think of as a W structure. Ideally, you want to get a W structure that comes where we go initially lower low, fail to do a new high, fail to do a new low, right? Consolidate and then break up and then finally kick off and go. And that will be something like this structure here, right? So again, you can see that go down, up, and then finally break, right? That's the best one. But visually, all of them work, but because we want to get it from the lowest point possible from any down or up move, that's what we should be looking for. As you can see with this down move here, there was no evidence of any kind of failure swing whatsoever. So again, it is what it is. Stuff like this you just want to skip out. It just doesn't meet the criteria, and for me it's pre the London Open anyway. Alright, hope you enjoyed the video. Hope you understand fully the beginnings of building a trading strategy. Right? Once you've started to understand that visual pattern recognition is the first step to building a trading strategy that's simple, that you can follow and execute consistently, and realize that it's all just about probability. Till the next video.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?